The Nifty is down about 248 points.
For now, it's around 1% cut that we are seeing on the Nifty.
Well, we had a crazy day in the market today. The market had a gap down, 250-point gap down. The market recovered most of it. On the Bank Nifty, actually, it went into the green. And then, for some reason, fresh decline, which took us back to the morning lows.
We end with cuts of more than 1% on the benchmark indices, but we are clearly off from the early morning lows, but we were weighed down by the weakness that we had across the global markets and the Q1 GDP print. Hello and welcome to CNBC-TV18. You're watching Markets Today, the show where we track 6 hours of the day's trading action in 5 headlines. I'm Sonia Shenoy, and these are all the headlines for the day. Wild swings on the Dalal Street. The Sensex declines by nearly 800 points and the Nifty loses 1%. Bank stocks along with oil and gas lead the declines, but mid-caps outperform with the index gaining, ending with marginal gains. And auto sales in August threw up a mixed bag. Maruti Tata Motors report growth of over 25% due to low base and some pickup in domestic sales, but exports come under pressure. Potential roadblock for the deal between Sony and Zee Entertainment report claims Competition Commission's initial review has said the merger will create a $10 billion TV enterprise which will have unparalleled bargaining power and can hurt competition. Zee responds saying its market share is down and CCI's questions are procedural. The Chief Financial Officer of SpiceJet resigns and the airline's first quarter losses rise 60% to nearly 800 crores. The auditor raises the red flag about SpiceJet's ability to continue as a going concern. And in stocks in the news, Biocon falls after the US drug regulator issues 11 observations each for its 2 sites in Bangalore and 6 observations for its Malaysia site. Credit Suisse ups its EPS estimates on banks. Well, here's what we have in store for you today. It's a packed show. In Market Opinion, we have Ajay Srivastava of Dimensions Corporate Financial Services. And in Corporate Voices, we have Keki Mistry, the Vice Chairman and CEO of HDFC. All right, let's start with all the market action of the day. It was a day of volatility on the Dalal Street. Both the Sensex and the Nifty lost 1% each. Weak global cues spoiled the sentiment further, with the Sensex losing 770 points and the Nifty losing over 200 points. But mid-caps managed to buck the trend, and the mid-cap index ended marginally in the green. Anuj is here with the market wrap.
Well, what a volatile day for the market on the weekly options expiry day, and coming a day after a day off. We were reacting to bunched up global cues. The SGX Nifty was down 350 points. We did start lower, not by as much, but still it was a big gap down. Then the Nifty recovered 200 points, fell another 200 points post-noon, and then had another recovery. So really was all over the place. The Bank Nifty, of course, traded in a much bigger band as well. And the mid-cap side of the market, that's been outperforming. And today also, for a better part of the day, advance decline was in favor of the advances. In terms of individual names, consumption has been doing well. So, names like Tata Consumer, Asian Paints, Hero MotoCorp, these stocks did well. And, the ones which underperformed today were really all the global plays. Commodities, Reliance was down, TCS was down, Hindalco was down, Tech Mahindra and Infosys was also down. As I said, the broader market did well. Some stocks which stood out included names like GMR Infra, Ashok Leyland, Astral, Tata Communications and SRF. All in all, a very volatile day, perhaps a bit of a teaser of what is to come in the months of September and October.
Okay, let's get you some expert opinion now. Ajay Srivastava, who's the CEO at Dimensions Corporate Financial Services, said that the IT sector is the most exposed to global markets, both on the demand as well as the investment side. He also discussed his outlook on defense stocks. Listen in.
IT has a particular problem among all the sectors. It has the highest proportionate ownership of FPIs, has the lowest proportionate ownership of the domestic investors, and certainly very low in terms of HNIs and individuals. And therefore, they are quite susceptible to what happened in the global market. That's one particular sector in India where the demand supply of stock comes into play very fast, because the moment the price goes up, the FPIs start to sell. And India, whether we like it, we like Infosys, we like TCS, the fact is retail ownership is low, institutional ownership is low, FPIs are over 40%. So what's happening in the US therefore translates more to the share price than perhaps the rest of the Indian economy. This is one sector totally exposed both on the demand side as well as on the investment side. Defense, government policy is very clear. The fixed returns to these companies are very clear. They give you a 7.5% to 12.5% return on every order, and all cost is passed through. What better business can you be? PSUs used to suffer because they could not pass through the cost back to the buyers at the end of the day, which are the retail public, whether fertilizer or banks, etc. This is one segment where the government guarantees that you execute the order, we will give you a 12.5%, or in case of Mazik and Dog, say 7.5% return. Now, it's a best business that you got to be local, you got to buy through them, easiest thing. PSUs get the order of priority, like Bell Electronics, for instance. You register with Bell and you can sell easily to the defense sector. You try doing it directly, you cannot do it easily.
Okay, in more market opinion, Suresh Tantia, who's a senior investment strategist at Credit Suisse, said that we will see higher interest rate affect the valuations in the Indian equity markets. He suggested, though, that banking stocks would be a good bet for the longer term. Take a look.
At some point of time, we are going to see convergence. But right now, the issue is that the global growth is slowing down. When the global economy is struggling to grow even by 1 or 2%, Indian economy last quarter grew by 13% plus. And this financial year, it's expected to grow by 7%. So everybody is looking for growth. And I think India is one place which is offering growth right now. And that's why we are seeing this divergence playing out in the equity market. But eventually, I think it will converge as the higher interest rate in India also weigh on the valuation of the equity market. I would still suggest to focus on the domestic economy. Those would be, once again, banks and FMCG stocks. Although banks have done extremely well, but they are not expensive compared to the rest of the market. And the credit growth is still very strong, around 15%. So I think banks would be the place to play on the domestic recovery. The other parts of the market, I think they could remain under pressure, something like tech stocks, because global economy is going to slow down, and that would mean MNCs could curtail their IT spending. So I won't be so bullish on the Indian tech names.
Okay, let's get to the top story this evening. Multiple brokerages have tempered their GDP growth expectations after India reported a slower than expected growth rate of 13.5% in the first quarter. But the Union Finance Secretary TV Somanathan remains upbeat about achieving an annual growth rate of over 7%. He also ruled out adjustments to the FY23 borrowing target, adding that the government will achieve its fiscal target this year. Lata is here with the GDP data and why the numbers did not meet expectations. Lata.
Well, first the numbers, GDP first quarter number came in at 13.5%. The CNBC-TV18 poll or the street estimate was between 15 and 15.5%. And the Reserve Bank's projection was 16.2. So it's lower than all that. Now, if you adjust this number to the Reserve Bank's projections, then the Reserve Bank's full year forecast falls from 7.2% arithmetically to 6.7%. Now, let me just explain why this 13.5 is a bad number. At the outset, 13.5 GDP growth over 20% last year looks good. I'll tell you why it's weak. If you take the actual Q1 GDP, it is 36.85 lakh crore. And this is only 3.8% higher than 3 years ago GDP of FY20. That's a poor record of growth.
Lata, as I mentioned, multiple brokerages have slashed their full-year growth outlook. Moody's has cut its growth estimates from 8.8% earlier to 7.7%. Nomura, Citi, JP Morgan and a few more have also trimmed their outlook. Is the 7% growth target for the full year now at risk?
Many brokerages have cut their full-year estimates, mostly to around 7 or below 7. Citi is the most important. They have cut their real GDP number to 6.7. They were standing at 8, so that's a huge cut. JP Morgan has merely said that they are standing at around 7%, so it's not above 7. Morgan Stanley has cut it from 7.6, where they were, to 7.2, so a 40 basis point cut. And CLSA was sitting at 6.7. They have upped it to 6.8%. But the short point is there is a very good possibility India will not get to 7% growth this year. It may be a 6 handle. Maybe 6.8, 6.9.
Okay, a sub 7% growth is what we're looking at. Thanks a lot for that, Lata. But in the money markets, the Indian rupee weakened marginally against the dollar. The rupee lost about 10 paise in trade today as the dollar index strengthened against most currencies. The 10-year bond prices also dropped marginally with the yield remaining above 7%. All right, on to the second headline now. Auto sales in August threw up a mixed bag this time around. Maruti and Tata Motors reported a growth of over 25% due to a low base and some pickup in domestic sales, but exports came under pressure. So let's talk about the stocks on your screen. We'll start with Bajaj Auto, which was a mixed bag this time around. There was very strong growth in the domestic sales, but exports were under pressure. In fact, it was an over 25% fall that we saw in export sales because of the slowdown in Nigeria. Nigeria has restricted two-wheeler movement, and that caused retail sales in Nigeria to fall 25 to 30%. However, domestic sales for Bajaj Auto were quite strong this time, and the management said that the month of September will be even better. Let's move on to the tractor segment though. Escorts reported a decent set of numbers and the stock was at a 52-week high today. Total sales up 7.5%, domestic sales an 8% growth and a 4% growth in export sales. This time, the management commentary was strong. They said you should see a better September for the sector and they expect a stretched peak selling season of 3 months. Ashok Leyland as well has been moving with quite a fast pace. In fact, overall sales went up 51%. MHCV sales were up 81% this time around. Can't say the same for Eicher Motors. That is its peer in the commercial vehicle category. Eicher Motors saw low single-digit growth of 4.4%. Talking about numbers that were below estimates, Maruti as well, on the back of a low base, saw a growth of almost 27%, but it was lower than the estimates, coming in at just 1.65 lakhs. Domestic sales growth was good, but exports continues to slow down. As I've been telling you, exports is a bit of a concern because of all the challenges that are happening globally. In fact, that was the conversation that we had with Bajaj Auto as well. Listen into what they had to say.
Decline in numbers which you're seeing in export sales is not really the outcome of Egypt. If you may recall, we had said that there are developments in Nigeria and a few other parts of Africa, but particularly Nigeria, where retails have slid downwards for two reasons. One is, of course, there is inflation and lower availability of dollars, but there is also an uncertainty due to certain pronouncements by the government of India, government of Nigeria, restricting the movement of motorcycles. The Nigerian retails have shrunk by 25 to 30% for us. And what happens in that is that we like to take a prudent view because it's a long supply chain. And if these retails continue at this level, we don't want overexposure of our distribution partners in terms of stocks. So this month has almost been a nil month of exports to Nigeria so that we take the hit and get the process of getting the stocks in balance. So it's really that one issue. And of course, the Egypt issue, which is a much smaller one when it comes from when you look at it from a number point of view.
Okay, let's move on to the third headline today. Reports suggest that the Competition Commission of India is concerned about the competitive implications of the Zee-Sony deal. Zee counters saying its market share is down and the CCI queries are procedural. The stock ended the day about 5% lower. Mangalam is here with more details on that. Mangalam.
Well, that's right. It's a tale of two cities for Zee. It's ICC versus CCI, and currently looks like the CCI news is weighing on the ICC story as well. So let's take a look at both these stories individually. For ICC, Zee basically has tied up with Star to broadcast ICC tournaments between 2024 to 2027, which includes 2 T20 World Cups, 1 Champions Trophy, as well as the 2027 ICC Men's ODI World Cup as well. The deal financials are not disclosed, but analysts believe that the valuations for this or the payouts for this would be staggered given it's syndicated, and importantly, it will give them the one piece that they don't have in their sports vertical, which is that of a good sports property. And between 2024 to 2027, the linear TV viewership could perhaps increase on the back of that. But that's a 2024 to 2027 story. The concern right now is the Competition Commission of India's questions with regards to the Zee-Sony merger after their initial review, and there were reports on that as well. Now, to that, analysts believe that because it's an initial review, it should not worry the eventual fate of the merger, because companies are usually in constant dialogue with the regulator all through the merger process. And secondly, the article that triggered this fear in the street was from Reuters, and to that the company said that That article quotes numbers from FY21, which included the Z and Sony combined market share upwards of 40%. And the latest data from BARC reveals that the combined market share for both Z and Sony are sub 35%. And as a result of which, legally, there could be a case for this merger to have no further hurdles as well. And from the company's standpoint, they have said that they are in conversation with the regulator. Be that as it may, the street does not like this uncertainty, and that explains why the stock is lower.
Okay, thanks a lot for that. We spoke to Abneesh Roy from Edelweiss Securities, who said that the brokerage firm was positive on Z, and he's in fact given us the stock a buy rating. However, he added that the valuation overhang will continue to remain on Z.
So we have a buy on Z. Of course, these issues are happening. There's a huge delay already in terms of exchange approval. But in terms of triggers, what we see is in H2, because commodity costs have corrected, FMCG companies, auto companies will come back in terms of advertising, a lot of the other discretionary. Also, NTO2, there will be more clarity in the second half. So these are the two triggers. The valuation is quite comfortable. But my sense is near-term overhang will remain till the CCI issue gets addressed, the NCLT approval comes. There is a near-term, definitely question mark, which we still are grappling with.
Okay, let's slip into a quick break, but do stay tuned and we'll be back in a jiffy with all the other headlines.